In Lesson 8.2, we're going to take a look at the first of our real finance applications. We're going to take a look at taxes. And we're not going to go deeply into this topic. We're just going to make sure that some of the language and vocabulary of taxing and some of the operations make sense. It's fine if you use tax software or if you have a business that you use an accountant, but it is good for you to understand the language of the tax system. In Texas, we don't have a state tax, so the only thing we're talking about right now is federal tax. All right, it says, this is out of your textbook. Calculating your federal income tax begins with gross income, or total income for the year. This includes income from wages that you get paid by your boss, tips, interest or dividends from investments, unemployment compensation, profits from a business, rental income, or even game show winnings or lottery winnings. It does not matter whether these winnings are in the form of cash or cars or vacation. You have to pay tax. They consider that income. Okay, the first thing you're going to do is be able to figure out your gross income, which is the sum of everything you earned. Then we will look at what's called adjusted gross income, which is your gross income minus adjustments. Now, adjustments are things that are not taxed. They are things like retirement accounts, tax-deferred savings, interest on student loans, even alimony. So, adjustments, this is income not taxed. And the IRS is very specific about this. Finally, we're going to get our adjusted gross income by taking away those adjustments, those things that shouldn't have been taxed or will not be taxed. And we're going to take your adjusted gross income. We're going to subtract from it your exemptions and your deductions, and we'll talk about those as we go on. All right, let's just look at our first one. We'll take this one step at a time, make this a little bit bigger. All right. It says a woman earned wages of $56,100 and $2,200 in interest from a savings account and contributed $3,700 to a tax-deferred retirement plan. She was entitled to personal exemptions of $3,800 and had deductions of $6,950. Find her gross income, her adjusted gross income, and her taxable income. All right, so we're going to do that down here. All right, we have, we have gross income. All right, it is the sum of her wages and her interest. So it is $56,100 plus $2,200. And if I add those up, I'll get $58,300. That's her gross income. The dollar signs will always be outside the little boxes, so I may start leaving them off of my work as well. Her adjusted gross is her gross income, $58,300, minus any adjustments that she has. Now remember, I read off the adjustments, and she had an adjustment of a tax-deferred retirement plan. So, and the key there is tax-deferred. So $3,700 of that income, it was nestled in here. 37 of it should not have been taxed. So we'll take that off, and that's $54,600. Now, her taxable income, and you can do this on your calculator just like I do it here. it is her adjusted gross, $54,600. Put a subtraction and parentheses. Now we're going to add up her exemptions and her deduction. Up here it says personal exemptions, $3,800, plus deductions, $6,950. Now, if you were having to do this by hand, you would do what's in parentheses first, and then you would take that and subtract it. But on our calculator, we have parentheses keys. So I'm going to put in 54,600 minus parentheses 3,800 plus 6,950. Close parentheses. And I get that her taxable income is $43,850. Let me go back and make sure I got that right. Yes. So, gross income is to add her wages and her interest. Her adjusted gross income is the gross income minus adjustments. Now, what are adjustments again? These are things that are not taxed, like retirement accounts, tax-deferred savings, interest on student loans, alimony. Okay? So they have probably already been counted somehow up here, and then we subtract them off. Then your taxable income, we'll talk more about these things in a minute, is your adjusted gross income minus your exemptions and your deductions. And this is what you have to pay tax on. All right, let's look at another one. I won't talk quite so much through this one. All right, same situation. A woman earned $43,900. She got interest from a savings account. It does not say tax deferred. This one is $3,000 to a tax-deferred retirement plan. She's entitled to personal exemption of $3,800, standard deduction of $5,950. Interest on her home mortgage was $8,100. She contributed to a charity, and she paid some state taxes. Okay, well, we'll talk a little bit more about some of these items and what categories they fall into, but we can start out with her gross income. All right, what did she earn? She earned $43,900, and she had interest that she has to pay taxes on of $2,300, and that gives us a gross income of $46,200. Now, her adjusted gross income is her gross income minus any adjustments. And remember, adjustments are things like tax-deferred retirement plans. So we get to take $3,000 off of that, and that gives us $43,200. Now, we need to decide, there are two kinds of deductions. We know that your taxable income is your adjusted gross income minus your deductions and your exemptions. Okay, let's see. There are two ways to go. There's standard deduction and there's itemized. And it all depends on how much, what's going on in your life, which is the better way. All right, let's take a look at her itemized deductions. What kinds of things are deductions? Well, she had $8,100 in mortgage interest. That you get to deduct that. she gave $2,400 in charity. You get to deduct that. And she had $1,375 in state tax. Okay, that means that her itemized deduction would be a total of $11,875. Those are all deductions. Now, there is such a thing as a standard deduction. The standard deduction is $5,950 for the year that this was designed, and let's see, here it is. She's entitled to personal exemption. Okay, we'll get that personal exemption in just a minute, and a standard deduction. Okay, she could use those two. Or you can figure out her itemized deduction. All of this, let me highlight it for you. All of that contributes to an itemized deduction. That's what I did over here. This is her standard deduction. The federal income tax laws tell us what our standard deduction is. You get to, if you can verify that you have other deductions, then you can probably go that way instead and actually lower your taxable income. So we need to find her taxable income. Now, would you rather get to deduct, which means to subtract, $5,950 or $11,875? And I think everybody would agree that this person should itemize. Lots of years you don't get to itemize. All right, how do we figure out taxable income? Well, it is your adjusted gross income, which is $43,200, and you subtract your exemptions. She had an exemption of $3,800 plus deductions, and you get to choose which one. I choose $11,875. You can do it all on your calculator. It is 43,200 minus parentheses 3,800 plus 11,875. Close those parentheses, and I get 27,525. 27,525. So the question did not ask specifically for should you use the standard deduction or the itemized, but it gave us the information for itemizing. So after we found our adjusted gross income, we determined that itemizing would be better. Okay, let's look at another one. This comes from 2012, and it says the marginal tax rate to compute the tax owed by a person, a single male, no dependents. Okay, so we're going to use this. This would be in a tax book. All right, let's see what they've got. This person has a gross income of $84,000. Okay, adjustments, $4,000. So let's start out. We already have the gross. Let's look at the adjusted gross income is 84,000 minus the adjustment 4,000. It's 80,000. Okay, now we're not taxed, she's not taxed on that completely. Let's take a look. The she has $35,000 in mortgage interest, so it is very important that she go ahead and itemize. So, deductions. She's going to itemize. I'm sorry, he's going to itemize. He's going to add, let's see, it's going to add 35,000. That was for mortgage interest. He has property taxes of $47.41. He had charity. Oops, go away. Go away. He has charity of 1,000. That gives us a total of $40,741. That's the deductions. Okay. And let's see. Let me get a little bit more space. All right. Taxable income is your adjusted gross. It was 80,000 minus your exemptions and your deductions. Now, a single person is exempted, whoops, 8,300, and his deductions itemized were 40,741. So he has taxable income of $35,459. So you can just put this straight in your calculator using the parentheses, and we have a taxable income. Now, there's more to this problem. We haven't answered the question at all. We got the adjusted gross income. We decided that this person had a lot of deductions, so they would itemize, so we've added those up. We know that your taxable income is your gross. Let me just remind you, it's your adjusted gross minus your exemption plus your deductions. Okay, so we've got that. Now we have to figure out the tax. Now you really have to pay attention to this. We said that this was an unmarried man, so he is in this column for single. This is a graduated tax rate. What this means is if you earn $8,700 or less, you pay 10% in taxes. But if you earn more than $8,700, the part of it, only the part of it that's more than $8,700 is taxed at a higher rate, 15%. If you earn more than $35,000 up to this portion is taxed at 25%. So this guy's amount is $35,459. Okay, so here's what's going on. All right, so your tax, it is 10% of the first $8,700 that you earn. It is 15% of everything between, well, let me erase this. Let me go in the right direction. Got to get it off the table. $35,350. $35,350 minus, so you have to pay 15% on all the money you have in that category, and then finally you have to pay 25% of 3, 5, 4, 5, 9 minus the 35,350, and I'll explain this more. I've been getting the numbers. Okay, so this is how much he's going to be taxed on, but different pieces of it he's taxed different amounts. So the first 8,700 of it he only pays 10%. The part that is between the 8,700 and the 35,350, you pay 15%. The part that is over 35,350, you pay 25%. So you pay different percents for different ones. So it's going to look like this. 10% is 0.10 times, whoops, $8,700 plus 0.15 times any money that you earned between those two amounts. And since my calculator's so good, I can type this in virtually as a formula. Plus anything over 35,350, but up to the full amount, he has to pay 25%. $35,459 minus 35,350. You will type this into your calculator exactly as you see it with the parentheses. And I'm not going to take our video time to do that, but you will get $4,894.75. Now, when you're actually doing your taxes, the tables in there do a lot of this for you. And if you're using some software, then it does it all for you. But it is interesting to see that the higher you go, pieces of your income get taxed at higher rates. The more you make, not only the more tax you pay, but the higher percent that you pay. Okay, now that's enough on those taxes. Now we're going to take a look at FICA taxes. In our next questions, we're going to talk about something called FICA. In addition to income tax, we are required to pay the federal government FICA, Federal Insurance Contribution Act, FICA taxes. Let me get my little circle back. All right. These are used for Social Security and for Medicare benefits. The Social Security provides payments to eligible retirees, people with health problems, eligible dependents of deceased persons, and disabled citizens. Medicare provides health coverage mostly to Americans 65 and older. Okay, if you look in your ebook, the FICA tax rate is on table 8.2, but what we need is given within our problems. So let's take a look, and we're going to find again this graduated tax rate. All right. Now, if you're self-employed, you do different things, but if you actually work for somebody, it's all right here, and the self-employed is over here. All right, this once again is 2012. If you are not self-employed and earn this, what are your FICA taxes? Okay, So you are not self-employed. That means you're here. Let's see. This person has income, and I would imagine that this is adjusted income of $119,000. You have to pay 5.65% on the first $110,000 and 1.45% on the excess. In other words, anything over that. So take this 5.65 and it's going to be 0.0565. So 0.0565 times the first 110,000 plus 0.145, which would be 0.0145 times the excess. Now the excess is the difference between, if you earned a lot, whoops, that's a zero, 119,000 minus the 110,000. This is in excess. It's what the difference would be. So this will be your FICA. Once again, you can just type this into your calculator, and it is $6,345.50. This is a government mandatory retirement plan, so that when you get to a certain age, you can actually draw on this. There are a few professions that you don't have to pay into this, but not very many. All right, let's look at another one. All right, on this one, this is kind of a long problem. We're going to do everything that we've studied about taxes in this one problem. All right, the first thing it wants me to do is figure out my FICA taxes for this person. Let's see. This person is in college, worked part-time at a restaurant, earned $24,000 in wages and tips. Gross income. And we'll go from there. FICA taxes, and she didn't have any adjustments, so her FICA taxes, according to the chart over here, 5.65% on the first 110,000. Well, she didn't make anywhere close to 110,000, so it is just the 0.0565 times 24,000, and I don't add anything onto it because she didn't exceed that 110,000. So that's going to give her FICA taxes of $1,356. And I was in error a few minutes ago when I said that this was based on adjusted gross income. It's not. It's based on just gross income. Okay, let's see. Calculate your income tax. Well, let's see. Her income tax is going to be, she does not have any adjustments. So her income tax, well, let's see, what's her taxable income? What are they going to do the tax rate on? Well, she had 24,000, and she's going to subtract her, let's see, we're going to go standard deduction because she didn't have anything to itemize, and personal exemption. So we're going to take 3,800 and 5,950, and her taxable income is 14,200 $250. Now, that's her taxable income. We have to come up here to the tax rate. And I'm going to need to get a little bit more room. All right, her tax. She's going to pay 10% up to $8,700 and 15% for the rest. So she's going to do, whoops, 10%, 8,700 plus 15% of, let's see, that next amount is, she had 14,250, and we subtract the 8,700. So she has to pay 15% for all of it above that. And she didn't go into the next category. Her tax is $1,702.50. Now, the only thing that made that easier was that she got to use the standard deduction, and we didn't have to add up, we didn't have to itemize for her. Okay, so her income tax is right there. And now it says including FICA and income tax, what percent of her gross income are your federal taxes? Okay, let's see. All right, total federal taxes are, she had $1,356. Let's make sure about that. Yeah, plus 17. Oh goodness, that's a mess. 1702.50, which is $3,058.50. Now that's her tax. So here's the question. $3,058.50 is what percent of, and her gross was, what was her gross? 24,000. So now we're going to use our percent proportion. So 3058.50, that's in the is spot. Of spot, 24,000. What percent? We don't know that. 100. And okay, so I'm going to cross multiply and then divide. So step 1, 3058.50 times 100 gives me 305,850. 305,850 divided by 24,000 gives me 12.74375. The instructions say round to the nearest tenth. That 4 will tell me to call that 12.7%. So we did a lot of work in that problem. We figured out FICA taxes based on the gross. We figured out taxable income by taking the gross, which also turned out to be the adjusted gross, and subtracting the exemptions and the deductions. We calculated the amount of tax, 10% on the first 8,700 and 15% on the rest of it. It would have gone all the way up to about 35,000, but she didn't make that much. And we got the tax, and then we found out the total tax, and it was what percent of her gross. Okay, a lot of work there. Now, the next questions that you have, you might want to look in your ebook. These talk about some of the vocabulary, and I won't be doing these with you, so be sure to refer to your ebook, and this is section 8.2.